So thank you for joining us today. My name is Patrick Dinan, and I'm the president and founder of Impact Fiduciary. I'm joined today with Andrew Olig from Calvert Investments. Calvert is one of Impact Fiduciary's investment partners, as we are currently utilizing two of their responsible index funds, as well as their small cap strategy. So for those of you who may not be familiar with us, Impact Fiduciary is a financial planning and wealth management firm that focuses exclusively on sustainable investing. We help our clients reach and maintain financial independence while investing in a better world. Today, Andrew is going to walk through Calvert's philosophy on responsible investing. We will then have a fireside chat and open it up to questions from the audience. If you have a question, please use the chat feature and we'll try to get to as many questions as we can at the end of the presentation. So without further ado, I'd like to hand it over to Andrew.
Great. Just sound check. Can you hear me?
Can hear you great. Yep.
Awesome. Well, thank you so much for having us. And for those of you that are joining us, thanks for taking some time. My name is Andrew, and I'm a responsible investment strategist with Calvert Research and Management. If you haven't heard of Calvert, we are really a core impact or responsible investor here in the United States. We've been at this for 41 years, myself in the markets for 23 and 10 years with Calvert. So what we'll talk about today is really kind of the landscape of responsible investing. Some folks call it ESG, some folks call it sustainable investing. So we'll talk about that landscape and what's really kind of driving this big trend towards people trying to understand the impacts that companies have on the planet and people and how they can align portfolios accordingly. I'll take a second to kind of frame it for you. If you think about just quickly the way we live today in 2023, globally, US, but even globally, the standard of living is way better than it was back at the start of the Industrial Revolution in the 1850s. And the thing that we kind of think about is if you have a much longer life expectancy, much more of the world is vaccinated, lives in a democracy, you have a much better chance of living to your 5th birthday today than you did in the 1850s, but capitalism and more importantly, industrialization have really had some unintended consequences on the planet and unintended consequences on people. On the planet, when you think of just climate change and biodiversity loss, and with people, really the kind of inequality and kind of the growing polarization between the haves and have-nots. And the gist of it is the largest companies on the planet have really had some of the most profound impacts on the planet and on people through their resource use, through, think about just climate change, or think about global agricultural things like that. They've had big impacts on the supply chain and on their employee bases. So what our thought at Calvert is how do we invest in a way that we can allocate capital using capitalism, using the market-based system to better really inform ourselves to improve not only portfolio outcomes, but try to also improve on environmental and social outcomes through that use of capital, through that market system. So that's really ultimately what we do at Calvert. And like I said, we've been at this, it's a very popular way of investing today. Over the last decade, it's really grown by leaps and bounds, by customer demand, from mom and dad with their IRA all the way to large institutional asset owners that manage big pension plans looking to align their investment dollars with the future and with sustainability. There's also been a large growth in the ability to do better work through information sets and through the number of investment companies trying to do this work as well, growing the number of solutions that you have as an investor to pull on and potentially invest in your portfolio. The other thing that we think about is the ability to signal management, to vote for positive change, to signal management as an owner of those companies to make them be better stewards of the environment or society. So ultimately, that's our philosophy at Calvert. It's been long held philosophy at Calvert that the companies that best manage these things, which were off the balance sheet, right? Climate change, carbon footprint, water use, the creation of waste, how you treat your people at the factory. all those things were kind of off balance sheet, but today they have much more of a direct connection to how these companies trade on the market, and either the creation or the erosion of value for investors. And so that's much more present today. There's much more awareness of that. And so we can clue into that and do a better job as an investment firm. So that's kind of the idea here. As Patrick said, I'm going to give you a couple of slides. We don't need to go through a 30-slide deck, but at any time, raise your hand, ask a question, and feel free to interrupt, and we can pay attention to it and do a good job. Just hopefully have a great dialogue. So that's ultimately our philosophy. How do we pursue competitive returns and drive better positive change? First slide I'll talk about is just kind of headlines in a portfolio, and think about some of these kind of macro issues that might show up on the front page of the paper. How might this affect your portfolio as an investor? How might this affect your potential value that you have as an investment? Climate change, top left, obviously huge rising costs. I'll show you a chart here in a second about rising costs and disaster relief here just in the US, where it's a big problem, whether it's fires here in California, where I live, in a little town called Walnut Creek in Northern California, or whether it's potential flooding. We saw a couple of years ago in Houston about 2 or 3 100-year events that happened to really affected not only the systems that people were living in, but it affected the way people lived for months. I have a friend down there that couldn't shower in his own home for over 2 months, had to go to a hotel and take a shower because pipes weren't working. And so this creates a cost, and it's a rising cost. But as an investor, think about this, what this does to the insurance world, to the reinsurance world, to the financial system, to ultimately just about every single sector we could invest in. And so that's just one headline. Think about another headline here. When you think about, potentially, we saw in March of this year, trains go off tracks because of what we would call product safety. And that affects how those companies trade. Were you invested in that company? That could have been a tough outlook, short term or even long term. What's really interesting is that from an ESG, and if you're not familiar with that term, what we talk about from an ESG perspective is kind of building out a full mosaic of investability for a company. So if you look on this chart at the bottom right, this is what every investment company wants to unpack for you. They look at the company, they break apart the balance sheet, they want to understand, how does it compare to other companies? What we try to do, and what other responsible investment companies do, and by the way, we're one of them. There's a lot of great companies that do great work. I can talk a little bit about how we do it, but there's other great companies that do great responsible investing work as well. What those companies do, in addition to Calvert, is really try to build a better mosaic. They look at a company from an environmental lens, if it's important to that business. I mentioned carbon and water and waste. Think about just carbon footprint today. Think about the IRA bill that got put into effect just over a year ago, that effectively sets a price on carbon and methane. If you're a company that's creating a carbon footprint and not thinking through the need to reduce that, once there's a tax on that, you potentially put, frankly, not even a potential, you put your investors at risk if you don't have a handle on it and have a way or a trajectory to lower it. From a social perspective, it's kind of a bigger bucket, but think about product recalls, whether it's big product recalls or whether it's smaller recalls in the pharmaceutical space. We've seen them in the automobile space. You have to pay your customers to bring your product back because it faltered. There's a cost associated with that. The other thing you think about, I would call product safety, would be cybersecurity. Think about how much of the world is on the web and on the internet today. If you are in those kinds of businesses and don't have airtight cybersecurity practices, you can see a huge erosion of value to your share price. And when you have controversy, it's interesting. I read a report last week from Bank of America that had you just looked through an ESG lens on Wall Street over the last decade, you would have avoided not only 15 of the largest bankruptcies on Wall Street, but you would have avoided over $600 billion in share price erosion, market cap erosion, due to controversies. When a company faces controversy, it tends to drop the price of that company's share, and it tends to stick around for quite some time. And that can be very crippling or hurtful to investment portfolios. And last, you look at governance. Are you an ethical company? So corporate governance looks at how companies behave. Are they consistently sanctioned? Are they, we look at accounting. If you remember the accounting frauds that we saw in the markets in 2008, interesting time period. So this is just a better way to look at the investability of a company, to then understand if you want to invest in it or not. I'll stop there, just see if there's any questions. Pat, does that all kind of make sense?
Yeah, this is great. And that actually brings up a question for me. Recently, over the last couple of years, there's been a bit of a backlash against ESG investing. I know in Florida, they passed laws that they're trying to pass laws that make it actually illegal to use an ESG framework when investing in companies for public funds, right? Could you talk a little bit about that backlash?
Yeah, it's interesting. So not to make it political, because that's kind of that third wire, but it's essentially been kind of a rallying cry around what we went through yesterday and what we're going to go through in the next couple of years with the political cycle, where these leaders of states are trying to rally their potential voter base. They seem to be kind of not very well drawn up and well founded. And in certain cases, some of these laws happened in Texas as well too, where they kicked out certain companies that have investment mandates, but they didn't kick out those investment mandates that were ESG. They were just kind of attacking all of it, and those companies that have bigger assets in ESG to originate their municipal bonds. And it actually is costing money because they had to go to the second or third or fourth company on the list that wasn't kicked out. And it's actually costing them money to originate those municipal bonds. That's in Texas. So it's starting to come back to them. It's pretty thin. It's pretty thinly veiled to really kind of rally an investor base or a political base. What we would say at Calvert is the thing that we would agree on. We think there's a middle ground, because they talk about don't invest in these things to create social policy. The investment should be ultimately what you're trying to figure out. We would come back to them and say, well, we don't know any firms that really try to do that. And definitely at Calvert, we don't. It's always an investment first theory, and that's called financial materiality. So we're looking at things like I just talked about that have a direct link to how that company trades on the market and what potential risk or reward you have as an investor if you potentially invest in them. So we think there's some middle ground. But we also realize that we're going to see some headwinds in certain areas from folks that are either miseducated or pulling kind of lazy data points to make an argument that are not as well informed.
Yeah, I was just going to say too, it breaks my heart. Sometimes I have clients that say, I just don't care about sustainability. I just want the highest returns possible. And my belief is that it goes, hand in glove. But what are your thoughts on just performance over the past, 10 years, and how has it helped or hurt, performance?
Yeah, it's interesting. There's a lot of different ways you can look at it. I like to look at this kind of graphic because there's kind of three ways to think about it. Institutional investors, right? The big asset owners, CalPERS and CalSTRS here in California, the New York Common Fund out in New York, the big teachers' pension. They're investing for the long term. They understand that there is this trajectory in certain industries that there are going to be prices on externalities. They're unwinding their exposure to certain things because they believe that a better incorporation of these lenses, like I talked about, can create longer, more sustainable, predictable results, right? Other investors that have come to us for years say, I want to make the positive impact at the forefront. And other people want to kind of incorporate their personal values, whether that be responsible values, whether that be sustainable or green, kind of green economy, whether there's a religious, like we do a lot of work for different dioceses and religious spaces. I think if you look at the middle of this graph and you understand that if you start with the investment first and understand long-term risk and opportunity, it satisfies all three of these types of equations. And I think that's what the ultimate goal is for us, but for other investors too. Why wouldn't you? If you can look at an investment and improve upon the environmental and social profile of the strategy, but also create predictable and consistent results that might be like or better than the marketplace, why wouldn't you consider it? And that's something that there's a lot of different ways to unpack it. Another example would be there's been studies that have been done at the security level and then at the strategy or fund level. And ultimately what these meta studies have found, thousands of studies over many different time periods, many different asset classes. At the security level, in stocks, about 95% of the time using an ESG lens, it's either neutral or additive to the process. So only 5% of the time they found that it was kind of a detractor. In bonds, 100% of the time, neutral or additive. What are bond investors? Longer term. What's the definition of sustainable? In perpetuity, right? And same thing with real estate. 100% of the time, neutral or additive to the process. And then the other thing is if you're going to do this work, you got to be able to do it as a fund manager, as an investment manager, do it consistently. What they found is that by and large, the strategies, ESG or responsible or sustainable strategies that you could buy in mutual fund or ETF form here today in the US perform on a risk-adjusted basis in line or better than their traditional counterparts over many different time periods. So I can use a lot of different evidence. I can also give you, a Calvert perspective. We've run responsible indexes for over 20 years. Over the last couple of years, we're pretty close to the benchmark, slightly trailing the US benchmark, the US Russell 1000, 3, 5, and 10, even 20. Significantly ahead. We're talking 150 to 200 basis points. That's 1 to 2% ahead of the market after fees. And so over the long term, it definitely works if you do it well and you have a process to do it consistently.
Yeah, that's great. Love to hear that. And I know the last couple of years, having a sustainable strategy has been hurt by the fact that we don't have exposure to the fossil fuel energy sector. And the fossil fuel energy sector has been the worst performing sector over the last decade until the last 2 years. And I think it was up 60% last year and 50% in 2021. So that definitely has taken away from performance. How has Calvert performed the last couple of years?
Yeah, well, it's interesting. So we performed pretty well in line. So our indexes have performed in line or better than their traditional benchmark, right? We have some active strategies that are, I would say median or above over the last year and a half. There's been some fundamental factors that have kind of brought that into play where we tend to have a quality bias, and what we found in the marketplace over the last really 2 years is that companies that are lower quality have been kind of outperforming companies of higher quality. So that I think in the short term has dragged us down a little bit. In the fixed income space, I don't know if you've looked at that, but significant outperformance in a pretty tough rising rate fixed income market. And so by and large, significant consistency, but I would also say very predictable, right? Think about why that's happened. Think about why energy, 15 years ago, 20 years ago, energy was not quite 20% of the value or its relative importance to the S&P or the Russell 1000. Over the last 20 years, with the growth of companies here where I live in Northern California, the change in the economic kind of output of the US, we've gone from a production type of economy to really a intellectual property type of economy by and large in the US. The energy sector has gone from close to 20 to about 5% of the relative value of the S&P. So its importance has shrank. what happened a couple of years ago, it was March, I believe, of 2021 now, right? That Russia was invading Ukraine, and that created really that was 2022, sorry.
22, yeah, yeah.
Yeah, COVID, I can't remember dates anymore.
All blends
But
together.
it created a huge energy crunch, right? And we knew it the minute that, because our biggest fundamental underweight is in energy. We own energy companies in the supply chain. We tend to not own the biggest E&P companies because it's really hard to pivot their business, especially in face of global policy, like I talked about with the IRA bill. There's a couple that are interesting that we're following. By and large, most of them, don't make it because they can't pivot their business. We retested our thesis the day that Ukraine was invaded. We knew that we were going to underperform because it was going to send energy and oil through the roof, right? But that's, I would say, that's not a surprise because of our philosophy. We have a set of principles at Calvert where we want to look at that environmental stewardship, and many of these companies are built to go do 30-year projects and go further out and deeper down to pull stuff out of the ground. And even at last summer's prices, those resources, by the time they go to use them, that project is economically infeasible. And so it's kind of bad money after bad at some point. They're making money on some of that reserve asset, but a 30-year project to go do more drilling just doesn't make sense as the world's trying to kind of trim their use of fossil fuels.
Yeah, that's my take is, if you look at the S&P 500, it's about 5% in fossil fuel energy. And I look at that as an added expense. Everybody talks about how you just buy the S&P 500 index, it's so cheap. But I think over the next 10, 15 years, that 5% position is really going to weigh down on performance versus if you didn't own it, right? If it's an opportunity cost, you can use that capital much more efficiently in other areas of the market.
Well, and I talked about externalities and price. I think this is one of the biggest things we should think about as investors over the next couple of years is that idea of pricing externalities. Think acid rain in the 70s, right? We figured we taxed those industrial companies, and they figured out pretty quick how to scrub those smokestacks and not pollute to create acid rain, right? That's coming. I mean, there's a price in that IRA bill on carbon and methane. The Washington State has a price on carbon. The EU has a border tax. Think about nat gas. We produce a lot of nat gas here in the US, but none of those production companies, not none of them, but the majority of those production companies aren't capping the well. They're hustling over to the next well. They're not capping it, and it's creating what's called phantom emissions. They want our nat gas over in Europe, but there's a border tax on carbon. They don't want to buy it because they have to pay the extra tax because it's dirtier. So, think about that as a company. If you're producing that, where are you going to sell it, right? And if you have all that reserve, but then they're going to tax it, they're going to handicap you before they pay for it. And so that's why it's a tricky equation for investing in some of these companies. That makes sense?
Yeah, I love that explanation. And before investing in the Calvert Responsible Index Fund, I poured through all the holdings, and one that caught my attention was Halliburton. And it's really one of the only companies that's in the energy sector that you have exposure to. Can you explain why that's in the portfolio?
Yeah, we look at the ability to pivot. We look at the ability, like, essentially, and I don't like to comment on individual names as much, but our philosophy is we want to look at really the direction of the company, right? And the ability, like, where are they spending money today? There's a couple others, as I mentioned, that are interesting, that are kind of building out carbon solutions, right? I think for some of those big energy companies, the carbon capture could be something because there's money in that part of the IRA bill. So essentially what we want to do is really look at where are they stewarding their capital, putting their investment dollars, and does that kind of jive with global policy and our set of principles? And I, I'm not even sure if we still own it. That's the thing. I need to look at that.
Yeah, I love how it's really if the company can pivot or not, and that's the factor that you look at when evaluating whether it's a good long-term investment.
Yeah, and that's ultimately our philosophy around anything, is understanding. Like, think about like tobacco, right? Like, it's a tough business. When properly used, it tends to create a health risk for its customers. And there's really no pivot. A couple of years ago, many of those companies tried to pivot to smokeless, and that's kind of incomplete on what that does to you long term. They're not going to do something different with the plant. So in our view, like, that's a tough business that really has no optionality, right? But there are, like, we own companies, like there's a company called Baker Hughes, which is a service company to oil fields, so they help kind of clean it up.
No, I
They've
apologize. That's actually the company that I had in mind. It wasn't Halliburton. It was Baker Hughes was that's the
Okay,
yep. Yeah, you're right.
yeah, because I don't think we own Halliburton.
Yeah,
That's
you
why
don't
it
own
kind of threw me
Halliburton,
off.
but they and sometimes they kind of run together, right?
Okay, yeah, Baker Hughes, the company that, so half their revenue was in kind of oil field service, but they just acquired a company in carbon capture and sequestration, and so, and there's revenue in that, there's technology in that, so they could be a leader, and so that's something where you want to look at that trend and see, like, where are they positioned today, but more importantly, where are they going. Again, another example would be some of these utility companies that create electricity that helps us turn on our lights. Some of them have started building offshore wind and solar projects to create renewable power and renewable electric generation. Some of them still burn coal and they have a carbon footprint, but they're retiring that faster and building out renewable capacity faster than competitors. And so we think, going back to kind of that decarbonization trend, if we think that's important, these are the blueprints on how we're going to get there.
And that also brings up another part of sustainable investing that tends to be overlooked, and that's voting proxies. So, if you're not aware, if you are a shareholder, you actually have a vote in different shareholder initiatives. And I'd love it if you could just explain how, Calvert approaches voting proxies.
Yeah. Well, so this is interesting. So as an investor on Wall Street, and so Wall Street's kind of set up as a meritocracy, right? It's survival of the fittest. And the only democratic part of Wall Street, really at all, is the ability to signal management. As an owner of these shares of companies, you have two levers at your discretion. Number one, any proxy, and that's essentially anything that's read at the annual meeting that shareholders can vote on, whether it's kind of business oriented to ratify the existing board and officers of the company. You've probably seen that. Or it's around anything like a resolution that might have been filed, which is the other lever you have as an investor, to signal management. Hey, company ABC, you're pretty good at certain things, but you're lagging the companies you compete on in transparency, on providing us with data, or you're lagging on diversity at your board level. And the world is asking for that. We'd like to see you change that policy. Think about utilities, right? You haven't built out a platform to decarbonize and transition to renewable power generation. So what's your thought on that? What's your plan to get us to 2030? So that's how you kind of signal management. You file a resolution, and then all the rest of the investors around the world can vote to either support or not support that resolution. At Calvert, it's issue by issue, it's vote by vote. But just to kind of give you a sense of it, we have a very well thought out proxy voting guideline. It's very transparent, by the way, so you can see how we're going to vote on our website right before any annual meeting. So if you own those shares, you can vote alongside of Calvert's, thoughts. Many times, I would say, kind of, this is broad brush, but we tend to vote more than Wall Street in favor of environmental or social resolutions. How are you going to do about clean water, clean energy, lower carbon, diversity at the board, things like that? How are you going to treat your workers and your human capital? So we tend to support those more than the rest of the street. But we also tend to vote against management. So those ones to ratify directors and executives, if we're not seeing enough movement, we tend to vote against them versus just putting them back in their seats like the rest of Wall Street does. So that's very broad, but that's kind of in a nutshell how we think about it.
Awesome. Are there any recent examples of shareholder engagement?
Yeah, I'll give you two. So one, so Tesla, right? Tesla's a great example because it's a pretty polarizing company.
Sure.
They disrupted how we consume energy. If you run an environmentally lensed portfolio, you kind of have to own. They're a big part of the marketplace now, right? And they've rewarded share owners over the last 5 years. So it's been a pretty good investment from that perspective. On the social side, they have settled one lawsuit to the tune of $140 million here in California. They've got another Department of Labor lawsuit in California on how they manage their human capital. And so if you run a diversity lensed or human capital lens portfolio, it's tough to own them. You can't really own them in that portfolio because they're failing on that. So that's an example of a company that we've engaged. First of all, we engaged them in 2019 on transparency. So Tesla changes the way we think about the environment, but they weren't even giving us a corporate sustainability report until we engaged them with one of our investors to actually kind of put it in writing. They weren't thinking about it, right? The secondary thing we went to is on human capital management. So we indicated that we were going to file a resolution with them because our view is that if you have a diverse labor pool and labor force, it maximizes your ability to be competitive. And Tesla was a lone holdout. There was not a lone, but there was about 18 companies that held out when we asked them for their employee demographic information. And so we actually filed that resolution. 54% of investors around the world supported that. And so now that they're providing us with their employee demographic information, because in our view, that's something, remember I said pivot or optionality? That's something they can manage. They're a young company. They just don't have the strongest policies in place. And so, if they can tighten up their policies and procedures, that'll make them a little bit more competitive and prevent any kind of erosion of talent. And as an investor, that's really what we want to do. We want to improve our footing as an investor so they don't have that erosion of talent, but they can also improve upon some of those social metrics that we look at, like diversity and human capital management. So that's a great example there. Another example would be the company Steel Dynamics that we started engaging in the late 2019s as well, 2017, 2018. Steel making is very energy intense and it creates a big carbon footprint, right? And we wanted to know, they weren't disclosing any information. Like, what are you disclosing? What's your information look like? What's your carbon footprint? How are you going to get to, how are you going to think about that when some of these policies come down the line? And fast forward to today, they're actually kind of the poster child for what needs to be disclosed from a steelmaking perspective. They're actually a U.S. steel company that's competitive with Chinese steelmaking, and more importantly, I think later this year, or maybe early next year, they're going to go online in Texas, of all places, with a renewable steelmaking plant. And so that's a company that through engagement, you get them to kind of think about the future and what's important to investors. And they're well better positioned than other companies that they compete against. So those are kind of two differentiated examples of how you engage a company on something that is meaningful to you as an investor, but still part of their business.
Yeah, I love this steel example because they'll probably have lower costs, lower energy costs over the long run and make more money because of that.
And they're going to pay less in carbon taxes when effectively the market price is set.
Yeah, that's great. Andrew, what would you say are you seeing or that are new trends in sustainable investing or responsible investing that, how is it different from 10 years ago or 20 years ago?
I would say number one, demand, right? So just virtually every demographic is at least interested in having this conversation. Remove the politics because it comes back to just the investment. Is this a good long-term investment, right? Sure. So I think demand, number one. I think number two would be the approach. So look at this chart. 10 years ago, there were only really 100 options in the US that you could choose from as an investor, mutual funds and ETFs. If I drew that line today, 2023, it's actually 611 sustainable strategies followed by Morningstar. So you can do much better job as an investor to or as a fiduciary for you, as really a consultant, to do a better job for people to tailor a portfolio. I think the other thing, this is a huge chart here. Look at this. A decade ago, a little over a decade ago, companies didn't give us information. They didn't give us environmental or employee information. Today, virtually the entire S&P gives us at least cursory level information. So with better armed with better information, we as an investment firm and as an investment community can do better work to handicap companies, to benchmark them, to understand where we want to allocate companies. So I think, or allocate capital. So I think demand, I think information, I think the number of options for you as investors, those are probably three of the most foundational changes. I think as we look forward, probably, there's two or three things that we're clued in on, I think, that are really going to make sense for responsible investors moving forward. Number one, I talked about it ad nauseum today, the pricing of externalities, right? We're going to see some market mechanisms, and when that happens, that's going to unlock the ability to create innovation, and you're going to want to pay attention to that, right? And we are paying attention to that. Number two, and I think probably maybe more important today, because it's going to take a long time to change the energy system, right? Like 4 or 5% of the overall global energy system is renewables. We're building it out, but it's going to take some time, right? So how do we decarbonize other parts of that industrial process, like steel, like cement, like I talked about before? Another thing we really want to pay attention to moving forward is just demographic change. So as investors, we want to think about change. Think about labor force in the US today versus 1960. Right? Women in the labor force was about 30% in 1960. Today it's 50-50. Think about educational attainment today, where bachelor's degrees and advanced degrees go sharply higher for women in every single ethnicity compared to people that look like you and I. Think about company management, though. Company management, by and large, in the US still kind of looks like the 60s. We've gotten diversity at the boardroom a little bit, but throughout company leadership, we haven't really seen a ton of change. And going back to that Tesla example, right? We've changed our economy from a production type of economy, by and large, to a more highly skilled labor economy. You want to stay competitive, you're going to have to source diverse talent. And so isolating companies that are leading, or importantly, companies that are improving, that's where I think you see some real potential investment, ability. We call it like an alpha signal. If you can isolate companies that are doing a better job with their human capital, with the people that they employ. Think about Microsoft, right? They employ 254,000 people. The environment part of the equation is not a big deal to what they do. They are going to offset their carbon all the way back to the 70s. That's good for them. Their biggest risk and opportunity is in getting skilled talent to keep them cutting edge, and that's something that we pay attention to very closely for companies like that at Calvert.
Awesome, love it. Well, I'd like to now open it up to any attendee questions. So if you have a question, please feel free to use the chat queue and ask away. And while we're waiting for some questions, Andrew, is there anything else that you feel is important that we didn't touch on today, just around sustainable investing?
I think I mentioned it before. I mentioned kind of the direction of companies and the direction of change, and isolating like what is changing in the marketplace. But I also like to set expectations, right? We're dealing with, like, in the US, these are potentially the 1,000 largest companies in the US. If you're dealing with a global portfolio, if you remove kind of the emerging markets, we're dealing with the couple thousand largest companies on the planet. None of them are perfect. These are big companies. They're nuanced. Any one of them at any time could have a lawsuit against them, could have an upset employee, could have an issue. What I think you want to find is more than perfection. You want to look at direction, and you want to really understand if there are controversies, are they manageable? Are they isolated? Or is there a pattern there? Because I think that's ultimately what you want to do. And you want to look for kind of the trend. Because these are big companies. Like, they're all in it to make money. that's why we want to use the capital markets to create positive change. That makes sense?
Absolutely. Yeah. And it's, you don't want good to be the enemy of the perfect, right? Or the other way
Right.
around.
Right.
So I think that the majority of the companies out there are trying to do the right thing. Probably 95% of the companies out there have businesses that can do better and can pivot. And I think that's why we're so aligned with Calvert's philosophy.
Yeah, and companies have done it like 10 years ago. Companies were doing a better job filling out surveys because the marketplace finally said enough is enough. We want to know what's going on. Today, the real leadership is companies are starting to compete on this stuff. Companies are competing on lowering their footprint. Companies are competing on building it out renewable infrastructure. Companies are competing on doing a better job sourcing skilled talent from diverse pockets of communities, not just the same person. So the leadership is there, and so that's why we ask them to continue to do better, right? And that's why we kind of continue to hold them to a higher standard. But companies have by and large gotten better, and that's where even if you can just eliminate the bottom quartile, you're set up for great success, right? And then if you can engage the ones that can target things that are doable, that's in their business kind of makeup, that's where you can get elevated growth.
Absolutely. And it looks like we have a question here. Understanding that Calvert leverages proxies to impact change with companies, how can investors see the impact or outcome?
Yeah. Well, they're kind of two-layer questions. So number one, we on calvert.com, you can actually go up and we have a site on our proxy voting, and I'll send that to you, Patrick, and you can send that out to everybody, the exact link. You can look up any company and how we're going to vote the numerous proxies on their annual ballot, right? And so you can see how we voted. And then in certain cases, like every year we publish a report called Tools of Change, where we highlight 4 or 5 of these stories that I've highlighted today on either the engagement, the resolution we filed, or how and why we voted our proxies, and then kind of give you some bar charts, right? Like how did we vote proxies against or for certain types of issues, to give you a sense of by and large how we're stewarding that. I guess third of all, we have a 35-page document called the Calvert Proxy Voting Guidelines on how we vote on every single kind of issue. So it's black and white there if you want to read through it. It's on our website if you want to look at it company by company on how we're going to do it. And then we publish an annual report called Tools of Change, which is for your investors to see kind of a synopsis of what we've done.
Awesome. I will definitely check that out. But great. And if there are no other questions, I'd like to just thank you, Andrew, for your time today, and just a great conversation. Really enjoyed it. I learned a lot, and I'm sure the attendees learned a lot as well.
Well, thank you. Thanks for having us. Let's do it again, and we can open it up. I really appreciate the questions. It was a great dialogue, and it's something that's near and dear to our hearts. But I think as we kind of get into it and kind of demystify it and set the right expectations, people understand that this stuff's pretty cool. So thanks for giving us a format to share some insights.
Absolutely. We'd love to do it again. And yeah, thank you, Andrew. And thank you, everybody, for attending. Really appreciate it.
Wonderful. Have a great day.
Awesome. Take care.